Welcome to the Explainer. Today, we're going to break down a really popular option strategy. It's designed to generate income, even if you're working with a smaller portfolio. This is all about consistency, not trying to hit some lottery ticket home run. So let's just jump right in with a problem I think a lot of you can relate to. You hear about selling options for income, it sounds great, but then you look into it and bam, you hit a massive wall. And that wall is usually the tens of thousands of dollars you're told you need. And to really get why the solution we're about to talk about is so clever, you first have to appreciate just how big that financial hurdle is. I mean, selling even one single, simple option can be ridiculously expensive. So let's use a real-world example from our source material. We're going to look at SPY, which is the big ETF that tracks the S&P 500. The trade we're looking at is called a naked put. All that means is you're getting paid a little bit of cash up front, and in return, you promise to buy 100 shares of SPY if it drops to a certain price. And here's the kicker. To make just $59 on this trade, $59, your broker requires you to have over $36,000 sitting there as collateral. For most people, especially if you're just starting out, that's completely insane. It's a total non-starter. But what if I told you there's a way to make a very, very similar bet without that huge pile of cash? You can almost think of it like a loophole for the little guy. It lets smaller accounts use the same kinds of high-probability strategies that the big players use all the time. And that strategy is called a put credit spread. Now, I know the name sounds kind of technical, but the logic behind it is actually super simple. You still sell that put option to collect your income, and here's the key. At the exact same time, you buy another cheaper put option at a lower price. That second option, that's your insurance policy. It's your safety net. And this right here, this chart shows you the power of that insurance. It's a total game changer. You go from needing over $36,000 with a potentially unlimited, terrifying loss to needing less than $1,000 with a loss that is completely capped from the moment you enter the trade. You know your absolute worst-case scenario right from the start. Okay, so let's pop the hood on this thing and see exactly how this trade works, using our SPY example. We're going to look at the specific options, the real numbers, the whole shebang. So why are we using SPY? Well, the source material had this perfect analogy. Trading SPY options is like buying or selling a Toyota Corolla. It's so common and so popular, there's always someone on the other side of the trade. That's what liquidity means. You can get in and out of your position really easily, and at a fair price. No getting stuck. So here's the two-part move. First, you sell the 362 strike put. That's your paycheck, right? That's the part that brings the cash into your account. Then, simultaneously, you buy the 352 strike put. That's your insurance policy. That's the part that strictly defines your maximum risk. So what's the bottom line here? Well, your total risk, the collateral you need, is just under $1,000. And for taking on that risk, you collect about $70 right up front. Now, do the math on that. That's a potential return of over 7% on your capital. And you can do that in just a matter of days. That is powerful stuff. Okay, making money is cool. But you know what's even cooler? Not losing it. So now we have to talk about the single most important part of any strategy. What do you do when things go against you? These are the rules of the game. You see, the whole philosophy here is not to be chained to your desk watching every little tick of the market. It's about being a disciplined, almost lazy investor. You want to be able to set the trade and walk away. But that only works if you have a crystal clear, predefined exit plan before you ever click the trade button. And here are those rules. They're non-negotiable. If the price of SPY starts to drop and gets near your 362 strike price, that's your warning siren. It's time to start watching that position like a hawk. Your absolute hard rule is this. If the price actually hits 362, you're out. You close the trade. The goal is to escape with a tiny, manageable loss, in this case, maybe just $7, to avoid taking that maximum $900 loss. All right, so when you put this all together, you take the clever trade structure and you combine it with these super strict risk management rules, what you're really building is a system that is designed from the ground up to play the probabilities. Now get this. Based on the options data at the time this was analyzed, this specific trade had a 96% probability of being profitable. Let me say that again, 96%. That means 96 times out of 100, the options would just expire worthless, and you would keep the entire $70 credit. No fuss, no muss. Now let's flip that around, because this part is just as important. That means only about 4% of the time, just 4 times out of 100, would you even be in a situation where the trade gets challenged and you have to think about using your exit rules. The odds are just massively, overwhelmingly in your favor from the get-go. And this really brings us to the key takeaway of this whole thing. With a strategy like this, long-term success isn't really about the 96 winning trades. It's all about how disciplined you are with the 4 inevitable losing trades. So the real question you have to ask yourself isn't just about winning. It's when the odds are stacked in your favor, how are you going to play those losing hands?